Okay, and go ahead and put up our book. Okay, and let's. Oh boy, let's see. Okay, no, we're okay. Don't panic, John. Okay. And let's just go ahead and take a look at the chapter 6 material. Okay. Now, we're going to talk about leases. Leases have long been an area where the examiners like to spend some time. You can expect about 10 points out of that material. Pretty straightforward, not a whole lot, but not a whole lot of terribly complicated calculations, but still somewhere where they like us to spend some time, um, point value wise. Derivatives and hedge accounting, very light, about 2 points. I am going to ask you to review the pre-recorded lecture for that. They're not going to be asking about derivatives as much going forward on the exam. So I'm going to ask that you spend some time looking at that on your own. Shouldn't take you too long, to maybe about 20 minutes to look at that, so that we save some time to help us to keep a little better on track here. Foreign currency accounting, that is a 5-point area on the exam. And I'll talk to you a little bit about how that could be folded into discussion of consolidations, which we've seen is a 10-point area on the exam. So you want to make sure and be comfortable with that foreign currency stuff in case they tie it into a heavier area on the exam, like consolidations. And then finally, we'll talk about, I assume we'll get to that tonight. We'll talk about accounting for income taxes. We're not going to be studying tax law for the FAR exam, but we are going to have to understand how a company would do accounting for their income taxes, for their financial reports. So we'll get into some of that. Okay. Okay, good. Again, this is chapter 6. And if there are no questions, we can go ahead and jump ourselves into the first part here, which is going to be the discussion of leases. Okay. Okay, good. Now, first, we're just going to take a quick look at some very basic things that really don't get much into the nature of questions that they'll ask you. But notice here that in order for a contract to even be considered a lease, it's going to have to meet the criteria here, both of them. Okay, so let's just go ahead and flashcard those. And in order for a contract to be considered a lease, it must be based on an identifiable asset, okay, in which the lessor does not have a substantive substitution right. The lessor is the person that's leasing the property to the leasee, okay? And then the contract must convey the right to control the use of asset over the lease term to the leasee. That's the person that's leasing that from the lessor. And the leasee will have the right to obtain substantially all economic benefit from using the asset and have the right to direct its use. So you can go ahead and flashcard that, but let's just sort of put that into a sort of a common sense kind of picture in your mind, okay? Let's say you want to lease a vehicle. You want to lease your car. Well, what's going to happen? You're going to go to the dealer who's going to be the lessor, and you're going to say, yeah, I'd like to lease that vehicle, okay? And once you lease that vehicle, you know, the lessor can't come and tell you, hey, well, you know, you can't drive it here, you can't do this with it. They surrender control of that asset, and then you turn around and you direct the use of that. Okay, so those are what the basic criteria are that would need to be met in order for this to be qualified as a lease. Okay. All right. Now we get into this next section here a little bit, and they start talking about various aspects of a lease contract and how to separate the various aspects of this lease contract. I am not going to get into that because it starts harkening back to separating out the various pieces of a sales contract and those that are going to be earned over time versus all at once. You know, I don't think you're going to see a lot of questions dealing with several contracts in one lease. And so I just want to move past that and get more to the more substantive part that you're going to be worried about, which is how do I classify a lease? Do I classify it as an operating lease or a finance lease? Okay, so come down over here to page 6, okay, and go past some of that material that frankly goes on a bit. And let's just take a look at an operating or financing lease, okay? And if you come up to the next page, just look at that graphic, okay? You have the lessor, okay? That's the person that's leasing the property to the leasee, okay? So this is in my little example, the car dealer. The lessor, this is the person that's going to be leasing the vehicle, okay? And it will either be an operating lease for the leasee, the lessor, or it will be considered a finance lease to the leasee or a finance lease to the lessor. Now, when we come down and we look at the finance lease for the lessor, there are 2 different types of finance leases. One is a sales type lease. And if there's a sales type lease, they're literally going to assume that you have sold that property. And so there will be a gain or a loss on sale. Okay, we'll treat it as a true sale. If it's not a sale, then they call that a failed sale, whatever. And then the only income you'll have on this will be interest revenue, okay? And we'll get more into that when we get into the discussion here in a little while, okay? Okay, now let's just go ahead and let's take a look at the criteria. And this criteria will help us determine whether or not we have an operating lease or a finance lease. So on the onset of the lease, both parties must determine whether the lease will be classified as operating or finance. Okay, the assessment is based on a defined set of criteria shown below on whether the leasee will in effect assume control of the underlying asset. Okay, so the criteria here are applicable to both lessors and lessees if any one, okay, if any one of the 5 criteria is met, the lease will be classified as a sales type lease by the lessor and a finance lease by the leasee. Okay, so we only have to meet any one of these criteria for it to be a finance lease for both the leasee and the lessor. For the leasee, the lessor, it will be what? If you meet any one of these criteria, it's automatically considered to be a sales type lease at that point of the finance lease. And we'll see what happens as to how it would become a direct finance lease. Okay. Now, this is one in which I do believe in the mnemonic a little bit. Okay. Because it's supposed to spell owns in a funny sort of way, okay? And so you can use that mnemonic. I generally don't care for the mnemonics, but this one's cute enough because you owns it, right? If you're sitting there and you're meeting the criteria for a finance lease, okay? So let's just look at these and flashcard them also, okay? And you probably have a flashcard in your Becker flashcards that will help you with that anyway, that already have these listed. But, you know, if you don't have it for some weird reason, make this, okay? But if there is some sort of ownership transfer, okay, by the end of the lease term, then we're going to treat that as a finance lease. So sometimes the lease will read at the end of the term, the asset will transfer over to the leasee. Well, that would be a reason to treat it as a finance lease, okay? If there is a written option to purchase and it is reasonably certain to exercise. So what happens here? let's say you're leasing, you know, a Rolls Royce, a really nice car, a Rolls Bentley, let's say, right? And they say at the end of the lease, at the end of the 3-year lease, you can buy the Rolls for $1. Well, you're going to go ahead and you're going to exercise that, right? So if there's something that is compelling to make us believe that you're going to exercise that written purchase option at the end of the lease, then it'll be considered a finance lease. Okay. If the net present value of all of the payments and any guaranteed residual value. Okay, so we have what? We have present value, net present value. Okay. We're going to start this today. Okay. You have what? You have the net present value, okay, of the lease payments and any guaranteed residual value. So it's both of them, okay? And any guaranteed residual value is equal to or substantially exceeds the underlying asset's fair value. They're saying, well, if you look at all those payments on a present value basis, you're basically buying that thing. We're going to make you treat that as a finance lease, okay? Coming down, if the term of the lease represents the major part of the economic life, or the asset is specialized such that there's no alternative use. In other words, you're pretty much leasing this property that only you can use at that point in time. Okay. Now, if you meet any one of these 5 criteria, then it's going to be what? It's going to be a finance lease for the leasee, and it's going to be what? It's going to be a sales type finance lease for the lessor. Okay. So now we're left with what? Now we're left with, well, okay, how does it become an operating lease for either the leasee or the lessor, or how does it become a direct finance lease for the lessor? Okay, so you take a look at the next page and they start to give us that criteria. So you can go ahead and flashcard what they tell us here. And again, you may already have this flashcard, but take a look through your Becker flashcards. If you don't, make one. Okay. If none of the above criteria are met, the lease is considered short term, or if the lease is considered short term, 12 months, it should be treated as an operating lease by the leasee. Okay. We're done with figuring out what the leasee has to do. If you don't meet any of those criteria, you're the leasee, it's going to be treated as an operating lease. Or if the lease is a short-term lease, 12 months, then it'll be treated as an operating lease. So flashcard that, okay? Then they tell us for the lessor, and let's see, we're going to figure out if we're going to treat it as a finance lease or not. So for the lessor, if none of the criteria above are met, the classification will depend on whether both of the following criteria are met. Okay, let's take a look at that. For the lessor, 2 criteria. I think this is supposed to be PC, but I don't know what it stands for, but we're just going to flashcard the criteria here. Okay, the present value of the sum of the lease payments less lease guarantee value not included. So you're saying, well, wait a minute. I thought you said that if the present value of the lease payments and the guaranteed residual value, if you met that, it was a lease. Yeah, it was a finance lease. But what happens here if they've taken out what? They've taken out the guaranteed residual value. If you still have, even after you take that out, if the lease payments and the third-party guaranteed value is equal to or substantially exceeds the underlying asset's fair value. So if you take out that guaranteed residual value and it's still, then that's going to be considered a finance lease, and collection is reasonably probable. When both of the criteria above are met, the lessor will classify the lease as a direct financing lease. If neither are met, if one or neither are met, then it's going to be considered an operating lease. Okay, so you go through and you can go ahead and flashcard this last part. Is one big flashcard, I guess, for the lessor. Okay, so it's either operating or finance. If you're meeting any one of those criteria, automatically a finance lease for the leasee, going to be a sales type lease for the lessor. If you don't meet any one of those criteria for the leasee, automatically going to be what considered operating lease, or if it's short term, 12 months, treated as an operating lease. If you're the lessor, you still have the chance of it being a finance lease, but you have to meet what? You have to meet both of those criteria that you see there. Okay. Question. Most of the things I've seen have not tested too much on these back criteria here, where you start getting into the small case of a finance lease for the lessor. Okay, most of them are going to be on that upfront criteria, that owns criteria, to see if you realize that you have a finance lease for either, and that it's a sales type lease for the lessor. Okay. All right, good. Let's go ahead, and they give you the decision tree here, but we've got some flashcards on that, so I don't think we need to go ahead and go through that little decision tree. Okay, so let's just go ahead and let's take a look at something that'll help us to kind of see how we might have to apply. And it's basically focusing here on the owns criteria for the leasee. Okay, so an entity, let's just take a look. An entity leases equipment, excuse me, leases equipment with a fair value of $3,500. Okay, lease payments of $1,000 per year due annually on December 31st. Now, remember, we said we have to look to see if the lease payments are what? Substantially all of the fair value, right? So then they tell us the lease term is 4 years and the asset's life is 10 years. Okay, they're telling me that because if I'm leasing it for substantially most of the economic life, then we're also saying that it could be a finance lease. Okay, then I come over and they continue and they say the entity has an incremental borrowing rate of 10%. The lease does not transfer ownership and there is no purchase option and the asset is not specialized. So they just knocked out 3 of the potential criteria here. They knocked out the ownership transfer, they knocked out the purchase option, they knocked out the specialized. So I'm now down to what? The substantially all the net present value, and I'm now down to, okay, I'm gonna have to look to remember what the criteria are here. I'm down now to what? The net present value or the term of the lease is substantially all of the economic life. So let me start with that economic life now. Okay, so the economic life, they tell me, is going to be how many years? 10 years. Where's the 10 years?
Third line.
Okay, there we go. 10 years. And the term of the lease is what? Term of the lease is 4 years, right? Thank you. Okay, so 4 divided by 10 is going to give me what? 40%. Well, 40% isn't even getting me up to half the life. So yeah, I don't think I'm going to make it on the economic life criteria, right? So now I'm down to 1, which is, does the present value of the lease payments substantially meet the fair value of the property? So what's happening? Well, they're sitting here and it doesn't say it's 100%, but it says it's getting close. So they go ahead and they use, sort of as a rule of thumb here, 90% of the fair value is 3,150. Then they go ahead and they figure out, well, what is the present value of these payments? And notice it's not 4,000 because we have to take present value. We would use present value of an annuity factor at 10% for 4 periods, and we wouldn't discount these dollars one at a time the way they're doing. We'd use the annuity factor, and when we do, we can see that what? The present value is more than substantially all of the fair value, and they're using 90% as a rule of thumb, and so this would qualify in this example as a capital lease. Not a capital lease, a finance lease. They used to call it a capital lease. Okay. Question? Okay, good. Let's go ahead then, and let's take a look then at the next page. Okay, since we see how we would use that criteria. And let's start to look at calculating the lease. Okay, and we know that we're going to be considering the payments and whatnot that will be made to determine what we should be recording as something called the right of use asset. So you come over and the leasee must recognize a right of use asset and lease liability for all leases that are not considered short term. In order to qualify as short term, the lease will have to have a term of 12 months or less, and there cannot be an option for the leasee to purchase the underlying asset. The short-term leases will qualify as operating leases, and the leasee will recognize payments over the term of the lease on a straight line basis. Okay, so we're going to be calculating the amount of this right of use asset based on the lease payments. Okay, so in order to calculate the right of use asset, we're going to be having to look at lease payments, and I'm going to ask you to flashcard the nature of payments that would be included in calculating the present value of the right of use assets. So you're going to flashcard these, but it's pretty straightforward. Okay, required contractual fixed payments. Almost every question you look at is going to say these are the required payments that have to be made each year under the lease agreement. So you're going to pick those up. Okay, now what happens? You have to have an option price, and it has to be reasonably certain that you will exercise that option price. Again, they'll say at the end of the lease, the asset's going to have a fair market value of $45,000, but you can purchase it for $10,000. Well, that's evidence that, hey, you're going to exercise that option because you're able to buy something that has a fair value of $45,000 for $10,000, right? Okay, or it just may come right out and say, it's reasonably certain. Okay, the purchase price at the end of the lease, the stated purchase price underlying asset at the end of the lease, when the lessor has the option to require that you exercise that. So now you're going to look at that and say, well, rule of conservatism says that the lessor will make me exercise that, so I would include that payment. Okay, now this one, only indexed or variable payments are picked up. Okay, so sometimes they'll say, well, you're going to be using the asset in excess of some amount that's allowed, and they want you to try to pick up the increased payments if you go over certain, say, mileage or something. It has to be called out as indexed to some certain amount, some inflation rate or something. If it's not indexed, then treat those as expense in the period when you actually incur that. Okay, so they would have to say specifically it's indexed somehow. Okay, residual guarantee value likely to be owed. If they say that you're going to crash this vehicle, and you're going to have to pay the residual value at the end, then you assume that you'll have to make that payment. And then any termination payments reasonably assured. Okay, so flashcard these just to sort of jog your memory, but I think the big picture to keep in mind here, if it looks like you're going to have to make the payment, okay, then go ahead and include that payment. The only one that I would say is you have to be a little more careful with that is make sure that they will only include payments that are actually indexed. They tell you indexed to inflation or something, use that specific language, then you would go ahead and include those payments. Okay, I don't know what the mnemonic is. I think sometimes these mnemonics get a little overboard. Okay, now notice that the lease payments may or may not include the following: non-lease components allocated to non-lease components in the contract, and lease payments will specifically exclude guarantees of lessor debt by the lessee and other variable lease payments noted. So flashcard that you need to make sure to exclude those payments down there. Okay. All right, now you come over and let's just take a look at this example, because we're giving you this long list of all the different things, and the best way for you to get comfortable with these is flashcard them like I've asked you to, but then as you start to apply them in specific problems, it's a little bit easier for you. So let's talk about payments to include here. Let's just read this example. Okay, so Sterling is a lessee for a piece of movable equipment with a useful life of 8 years. Along with the equipment, the lessor is providing scheduled maintenance and upkeep that is accounted for separately from the lease. The terms of the lease include the following: 3-year lease with monthly fixed payments of $34.50. Okay, you're going to pick those up. That's the lease payments. That's basically what you're paying out. That's how we're going to calculate this right of use asset. Now they tell us that the first 4 months are free. Now that is a long established trick on the exam to get you to think, oh, okay, the first 4 months are free, so I should count those as zeros somehow. And what you're going to do is pick up what? $34.50, and if it's a 3-year lease, that's how many months? That's 36 minus what? 4 months. So you're going to take that $34.50 and divide that by what? $34.50, I should say, multiply that by what? 32. That's going to give you the total amount that's going to be paid out over this lease for the 32 months that are involved. Okay. There's an option price here. Option price at $12,500, which Sterling is unlikely to exercise. And so if they're unlikely to exercise, do you think you're going to include that? No, you're looking for language that is really specifically making you feel, okay, yeah, they're going to have to pay this. And then $8,000 allocated to mount maintenance and upkeep agreement. Well, that's starting to sound like that's going to go outside now of the lease agreement, and this is some sort of upkeep. Okay, so let's just take a look though at the solution. Lease payments will include $34.50, fixed month payments for 32 months. Okay, 36 less the 4 months. Option price for $12.50 is not included because what? Unlikely. The $8,000 allocated to the maintenance and upkeep portion of the contract is also not included. That is like a second agreement, right? That has nothing to do with the lease. It's an upkeep. It's sort of like the guarantee or the service contract that we talked about back in chapter 1 when we talked about revenue recognition. Okay, so let's take a look at this number 4 here. Lease payments, illustration 4, lease payments excluded. And so when we look at lease payments excluded, Bowden is the lessee for 2 separate lease agreements. Lease A involves monthly payments that are based in changes in the consumer price index. Lease B involves monthly lease payments that are based entirely on Borden's use of the lease. Okay, so what happens? We come over here, and for Borden, the calculation of the lease payment for lease A will include the variable monthly payments because they are based on an index rate. So again, you're looking for what to include. You're looking for specific language that says it is indexed to the consumer price index or something. For lease B, the payments will be recognized as expense in the period incurred and not included in the lease payment calculation because they are contingent on use. I mean, just think about that last part. Think about what we say about accounting in general. It's based on past transactions or events. Well, at this point in time, we're sitting here and we're saying, well, look, we haven't even used this yet. Maybe then we'll never use that amount, so it would not be appropriate to take it up front. And then you're going to have to wait until you actually incur that. And it's a better matching with any revenue that would be generated from that extra use. Okay. Okay, so we know what payments to include. We have our flashcard. We got to include the lease payments, any residual value that's guaranteed that you're likely to do. If there's a bargain purchase amount, are you likely to exercise it? All that. But remember, we're using present value. So we have to try to figure out what is the appropriate discount rate, because CPA exam problems love to give you more than one rate to consider, and you have to know which one to pick out, right? So when calculating the present value of the minimum lease payments, the lessor will use the rate implicit in the lease because the lessor knows the rate. The leasee will use the rate implicit in the lease if known. Now you look at this and you say, well, how would they not know? Well, when you lease property, sometimes lessors get a little funky in how they describe the interest rate that's associated with that. And so it is possible that you're not going to be able to figure out what was implicit in the lease. And if that's the case, and frankly, for the CPA exam, if they tell you, hey, the leasee does not know the lessor's rate, or they say the leasee does not know the rate that is implicit in the lease, then you're going to have to go with what they would have to provide you at that point in time, which is the incremental borrowing rate, the rate the leasee would be charged for a collateralized loan with equal payments and similar lease terms. Okay, so if they give you two rates in there, you look, you see, they tell you the leasee knows the lessor's rate, then you'll use the lessor's rate. If they say the leasee doesn't know, then they're going to have to give you that second rate, and that would be the incremental rate that the leasee could get in the market. Okay, would be charged for a collateralized loan with equal payments and a similar lease term, basically what's available to them in the market. Okay, okay, good. Now you come over and let's look at these initial direct costs. Okay, and we're going to use the initial direct cost, and these costs in the calculation of the right of use asset. These costs are only incurred as a result of the execution of the lease. Okay, any cost incurred prior to signing the lease is going to be expense. It's not going to be included. For example, they make you pay for a credit check. That is not part of the cost. So the initial direct costs will be included. These costs are only incurred as a result of the execution of the lease. The credit check, that kind of stuff, you would not include that. Okay, anything that happens prior to signing the lease. Okay, now what I want to do is take these terms now and start to apply them to the numerical examples that are coming up. And what bothers me here is that Becker kind of throws all that upfront information overboard, and then all of a sudden sneaks in this sales leaseback thing, which I don't know why they decided to do that. I'm going to come back to this. Someone's going to remind me, Davi or somebody's going to remind me to come back to this after we finish now the discussion of how we apply these different terms in determining if we have an operating lease, do we have a finance lease, how do we treat these payments, what discount rates do we use. We're going to focus on all that, and then we'll come back to the sale leaseback stuff after that. Okay, so what I want you to do is go away from the sale leaseback stuff for a second and come with me, and we'll come back to the questions again. Well, you know what? We can do the first question here. Let's do the first one. The second one is a sales leaseback question, and I just want to come back to that. But we can do question one, then we'll come back after we go to part two, module two. Then we'll come back and pick up this second question. But let's do the first one. And I'll go ahead and give you some time on this. I'll put up the poll, give you a little time to look at that. Assuming I can find my cursor. I don't know why they're making it so hard for me these days. Okay. All right. Okay, guys, I'm going to go ahead and end the poll for this one. So take your best shot. Okay. And so we take a look, and yeah, good. Most of us got this right, but let's just go ahead and take a look and see how they, what the fact pattern was here, and see if we can apply the criteria. So what happens? Watts enters into an agreement to an agreement to lease a printer from Jennings. The lease is for 3 years and does not stipulate an ownership transfer. So no ownership transfer, no O, or wouldn't it be nor contain a written option to purchase. So we've got the O out, we got the W out. The printer copier has what? A 5-year life. Okay, well, what do we got? We've got a 5-year life here. And we've got what? The lease is for how many years? 3 years. What's that? Is that 60%? Is that substantially the entire life? No, that's kind of still pretty low down there, right? Okay, so far I haven't seen anything that will make me think that this is a finance lease, excuse me. So then I go and I say the net present value of the lease payments is approximately half of the overall fair value. Well, there goes the net present value criteria and of the overall fair value of the equipment. And there goes any sort of, payment that will be made at the end to purchase that we think they're likely to make. They don't give me any of those continuing on criteria that might cause me to want to treat this as a straight financing lease for the lessor. Those other criteria that I told you, they typically don't ask about that. So yeah, this has got to be what? For both of them, this has to be an operating lease. Okay. Question? Okay, we'll come back to question 2. I don't want to sit here and do it now because it's dealing with a sales leaseback. And the problem that I have is we spend all our time understanding operating versus financing lease, what payments do we include and whatnot. And then they completely shift gears on you and talk about a sales type lease rather than kind of exercising our brain, helping us to look at the different criteria that we just looked at. The sales leaseback type lease instead of, hey, is it financing, is it operating, et cetera. So let's first take a look at the operating lease, okay? And if it is an operating lease, the balance sheet is going to reflect a right of use asset and a lease liability, and both will be amortized over the life of the lease using the effective interest method. Beautiful. Sometimes a first sentence in a discussion is worth flashcarding because it just comes right out and tells me everything I need to know here, okay? The right of use asset and lease liability amount are calculated using the present value of the lease payments and using the appropriate discount rate. Again, we talked about using the rate implicit in the lease by both. Unless the rate implicit in the lease is not known by the leasee, then they'll use whatever rate they have available to them in the market, okay? Now you come over and you take a look at this last sentence. Instead of reporting interest expense on the income statement, we will report the interest as part of the lease expense. So you'll be able to see that there is a interest component to this, but we call the entire amount lease expense when we're talking about, of course, an operating lease here, okay? So let's just go to this numerical example. And they give me journal entries without numbers, which I hate, but thankfully they later on give us journal entries with numbers. And so it is much easier to understand as you start to take a look at this, okay? So let's just see what they gave us in this problem. And we say on January 1st, year 2, leasee enters into a 3-year operating lease with annual payments of $18,000 per year. The first payment will be made December 31st, And the interest rate implicit in the lease is 5.75%. The present value of the ordinary annuity for 3 years is 2.685, etc., right? And then they say prepare the journal entry for the lease at the commencement date, the end of year 2, end of year 3, end of year 4. Okay, now they come over and they tell me that the present value of the 18,000 for 3 years, and they just gave me the one and only factor I can use there, is this 48,338. So we're going to go ahead and take the 48,388, and we set that up as the right of use asset just by taking that present value calculation. Okay. Now notice we set up the asset, we set up the liability, and then all we're going to do is amortize that liability, and that amortization of that liability is going to match the amortization of the asset so that these will both be zero by the end of this operating lease. So we go ahead and we take the 48,338. We multiply that by the interest rate that they told me here, which is 0.057. Okay. And when we do the math on that, sort of the interest component, even though we're not going to call it interest, becomes this I got 779.43 when I did the calculation, which is basically that number right there. Okay. And so what happens? We have the payment of 18,000, the payment of 18,000 minus the, and again, I'm putting quotes around interest. It is interest, but we're not going to classify it as interest on the income statement. We're going to roll the whole amount into lease expense, but 18,000 minus 2,779 means that we're going to take what? 15,221, and that's going to come off of what? Come off of this 48,338, and that'll give me the carrying value for the next year. Okay. Now come over though, and let's just take a look at the first journal entry. Okay, because they did ask me for the journal entry for each of the years. So at the end of the first year, year 2 is the first year. Why they had to make it year 2, I don't know, because they wanted to confuse us, I guess, but that would be the first year of this lease. Notice we do what? We go ahead and we amortize the lease liability, and we take what? Basically an accumulated depreciation against, we call it accumulated amortization, against the asset and against the liability, and that's the amount that went towards the principal. And then we simply do what? We simply debit lease expense 18,000 and credit cash 18,000 for the amount of cash that's paid out. So we go ahead and we roll both the interest part of the payment and the principal part of that $18,000 payment. We roll that into an account called lease expense. You credit the cash for the 18,000, and then the difference between the amount of cash you paid and the amount that's the interest portion, and again, we don't call it interest, the amount that's the interest portion, that will amortize the liability, and at the same time, it amortizes the asset. Okay. Question? Okay, good. Then you go into the remaining years, and you'll continue to amortize that liability, and you'll just take the 18,000 every time as the lease expense. I mean, please God, may they ask you in a question for an operating lease, what's the lease expense? And it's going to be whatever cash got paid out, right? That's always the same. So that would be a 2-second answer for you. And the amount that's going to amortize is the difference between what? the difference between the cash and the amount of interest, right, that you paid. And you get the interest by taking, let's just go ahead and calculate that one more time. 33,117 times 0.057. What do you get? I calculate that. I didn't verify that calculation earlier, but let's just take a look. 33,117 times 0.057, right, gives me what, 18, huh? What'd I do? $33,117 is the carrying value after that first year, right?
I think you need to add, it's 5.75%. You are only multiplying it by 0.57.
33,117. Oh, I see. You're saying 0.0575?
Yeah.
Times 0.0575. Yeah, gives me 1904. Thank you, Tommy. Gives me 1904. That's that interest piece, right? And you would just go ahead and whatever the amortization, whatever the interest part is, what you're really interested in is the difference between that and the cash. That part amortizes the asset, amortizes the liability. Okay, and you can see that on the next pages. Okay, you can tie that back to the table. Any question? Okay, good. Now, you know, that's pretty straightforward, I think. You know, it's something you got to get used to a little bit. To me, the finance lease is even easier because now you don't have to sit here and have that kind of funky thing where you're debiting cash, debiting expense and creating the cash, and then you're taking that amortization off the asset and the liability. It's more on how we would treat amortization and of any liability now, and it's more how we would treat depreciation of any asset. Okay, so let's just take a look at that. If the lease is a finance lease, again, we'll recognize the right of use asset and corresponding liability. The liability will be equal to the present value of the lease payments owed. The ROU will include initial direct cost, including consulting fees that were incurred as a result of the execution, as well as the lease payments made by the lessor at or before lease commencement. Okay, we've already talked about what payments to include. So any incentives received by the lessee from the lessor will reduce the value of the asset. So they start going on a bit there with the different payments again to include, and they kind of throw away how we're supposed to account for this thing because we've kind of already talked about the payments. So let's just go ahead and let's take a look at reporting a finance lease now on the lessee's books. So we come over and they tell us that they have the same facts, 18,000 for 3 years. First payment is made at the end of the first year at a rate of 5.75, and the present value is equal to 48,338. So they go ahead and they set up that 48,338, and then as you saw in the previous table, same information. Some of that payment is going to go towards the interest. Some is going to go towards the amortization of the liability, and then you've got the total of those being your lease expense. Okay, so notice now you've got what? You've got this interest expense portion. You've got the amortization of the liability, and of course you credit the cash. So this is how you would amortize any liability, right? And then you have this amortization expense, and the amortization expense is going to be this 16,133 and the 16,133. Now to get that, we're simply going to take the amount that we had capitalized here, which is our 48,338, and we're going to divide that by, what was the years of the lease? 3 years. And that's what gave us what? That's what gave us the 113. So we're going to go ahead, and we're now going to go ahead and simply what? Depreciate that on a straight line basis. So you're basically doing what? Doing what you would do to amortize any liability and doing what you would do to depreciate any asset here. Okay. Okay, good. All right, you would continue on like that through the remainder of the lease for the rest of the years. All right, good. You don't have to go through each year to be able to do that. Okay, so they give us more of the same here with calculating that right of use asset, the table, and in a more comprehensive manner. I'll let you look at that on your own. Okay, all right, good. So let's take a look at the lessor accounting now. Okay, and for the lessor, first we'll look at a sales type lease. Then we're going to look at the financing lease, and then we're going to go back and we're going to look at what happens if it's a sales leaseback. Okay, so let's take a look. In a sales type lease, the lease gains control, the leasee gains control of the underlying asset. The lessor will de-recognize the asset and recognize a net investment in the lease as well as profit or loss. Okay, so you can go ahead and flashcard that if you want to, but it's important or can help you to remember how to handle sales type lease. And I wrote that in the little chart that they had there at the beginning for a sales type lease, that the lessor will recognize gains and losses on these. Okay. Now, again, here come these initial direct costs again, and they tell me for any initial direct cost incurred as part of the lease, if there's a profit or loss, expense the direct costs at commencement date. If there is no profit or loss, defer and recognize them over the term of the lease. Flashcard that, but that kind of makes sense that if you're taking a profit or loss on this, then it makes sense that any additional cost would be matched with that gain or loss at the time of the commencement of the lease. If not, no profit or loss, then don't recognize those at the commencement and amortize them over the term of the lease. Okay. Now we come over and let's just take a look at this fact pattern. I'm gonna go ahead and use yellow for that, I think is better. Jenkins leases a truck to Biggs at $5,000 per year. The initial direct cost at $450, and the interest rate is 6%. On the date of the lease commencement, the carrying value and fair value of the truck are $22,000 and $24,216 respectively. Now I look at that and I know, okay, we've got a situation where we have a sales type lease. We're going to have a profit associated with this, right? Because the fair value is more than the carrying value of this truck. Jenkins expects the truck will be worth $8,700 when the lease ends. And we go ahead and they give us some of the criteria here. The collection is probable, etc. So we know, okay, we've got a sales type lease. So we come over and let's just go ahead and let's take a look. And the present value of this 8,700 at 6% is 6,891. So we recognize the residual lease. we have what? The present value of the 4 payments is 17,325. We set that up as a lease receivable. So that's what they meant as they're going to recognize their net investment in the lease. It's what they're going to get back on this property, because the property is going to come back to them at the end, and whatever cash they're going to get out. So that residual asset, the present value of that, plus the cash that they're going to get, that's their net investment in the lease. Now you look, they take the truck off at its book value, and if there was depreciation and the original cost of the truck, I guess you'd have to do that journal entry that way, where you debit the accumulated depreciation and credit the truck for its original cost. They're just taking it off at its book value there. And then they're going ahead and since we're going to recognize a gain on this, we're going to go ahead and expense all of those initial costs that we had to pay, that 460, whatever, 450. And then notice, if you take these two amounts, this is equal to what? Is equal to what they told us the fair value of the truck was, whatever was 24,000, whatever. And then you subtract off what? The book value. That then becomes what? That becomes the gain. Okay, so you simply take the difference between the book value and the fair value, and that's the gain. And then you're going to take that expense here because you recognize the gain. So they tell us to expense that. Now, if it is a direct financing lease now is not going to have a gain or loss. So any gain or loss will be what? Deferred, and loss will be, any losses, of course, are recognized immediately. Losses are always recognized immediately. Any gain is deferred. So let's flashcard that, and let's make sure that you don't make the same mistake that I just did. It's gain that's deferred. Losses are taken immediately. Okay, so let's just look at the numeric example. Again, I don't care for journal entries without numbers, but let's just take a look at this one. And we have Jenkins leases a truck to Biggs for 4 years, $5,000 per year, with an initial direct cost of $450. On the date of the lease commences, the carrying value of the asset, the carrying value and fair value. Okay, so there's no gain there. Okay, carrying value and fair value. Jenkins expects the truck will be worth $8,700 at the end of this lease. Okay, so what do? We go ahead and we set up the present value of the lease payments, the present value of the residual value. We go ahead and we credit the truck for $24,216, and we go ahead and credit the cash, of course, because we're paying the cash. So in effect, what they've done, if you notice the difference in the lease receivable amount, is that 450 has been rolled in that lease receivable amount. If you look back at the previous problem, we took that as an expense. Here, we rolled that 450 into the receivable amount, because again, there was no profit. This was not a sales type lease. This was a financing lease. Now notice that as we go along now, the only profit that we're going to see on this thing is going to be the interest income. Okay, so as I had you right there, there will be a profit with the finance lease. The only thing you get is interest income. And you think about it, since they sold the asset for fair value, you're right, the fair value and the book value were the same, then they weren't really trying to make a gain on the sale, and were just simply trying to make money off of the financing. Okay, so we got the present value here is what? Is this 17,000, the present value of this was the 17,000 of the 4 payments at 6%, 17,000 plus the initial direct cost. That's where they got that 17,000. And then you simply are going to do what? You're simply going to amortize that by getting the interest expense. And now it's interest income, the 14,480. The difference goes to what? Goes to the lease receivable. Okay. Okay, good. And then presumably you will do what? You'll get that equipment back at the end. All right, good. Now, if it is an operating lease for the lessor, now it becomes what? Now it becomes real easy for us, right? So we're going to go ahead. Let me, are we clear on where we got this number? That may not be the easiest thing to see where that 1480 came from. Okay, let's just make sure we're clear on that. So we took what? We took the 17,775 plus what? Plus 6,891, right? These two numbers right here. Okay, that's my entire investment here. And when I add those two numbers together, do I get 24,066? What is it? 664? Somebody got a confirmation on that number?
I got 666.
666. Okay, I can't read my own writing. Okay, 24,000. You say 666?
Yes.
Times 0.06. Thank you. Times 0.06 now. The interest rate that they told me on this thing gives me what? 1479.96, close enough for government work to 1480. Okay, and that's how we'll amortize that. Essentially that's our net investment here in this, and we're earning interest on that investment that we've given here. So the key thing is, you know, knowing to add that 450 because we sold to the lease receivable, because we sold the asset for its for its carrying amount, fair value were the same, so there was no gain there. Okay. Okay, good. Operating lease is very simple. Whatever you get in cash is your rental income. This is for the lessor. And then you just simply depreciate that asset, because the idea is, hey, I'm not selling it. There's no finance lease here. There's no sales type lease. There's no finance lease. It's simply an operating lease, and I'm just going to rent this thing out month to month, year to year, and I still own the asset, so I just depreciate the asset. Okay. Okay, good. Come over and let's take a look at the criteria for amortizing the right of use asset. Okay, so the right of use asset will be amortized beginning on the commencement date using the straight line basis. Okay, but what period should we amortize it over? And we should amortize it over the asset's useful life if we have qualified for a finance lease here under the ownership or the written option. If we have what? If we have met the requirements now because of net present value or economic life or specialized asset, then use the shorter of the lease term or the useful life, whichever is shorter. The idea here being that, hey, in the first case, in the yellow here, you're going to end up with the asset. So just use the asset's life. If you're in the blue over here, then what? Maybe you're not going to end up with that asset at the end. So amortize it over the shorter. And they sort of say, or the shorter the term of the lease or the useful life. but that's almost always going to be, the shorter is going to be the term of the lease, because most companies wouldn't lease a property for longer than its useful life. That would be kind of a bad business decision. So it's probably going to be over the term of the lease. Okay. Okay, good. Now you come over and I don't know why they have to tell us, but let's just look at it. This would be part of continuing operations on the income statement. So flashcard that if you need to. It is nothing to do with comprehensive income at all. Okay. And then on the statement of cash flows, okay, let's just go ahead and flashcard what shows up where. And notice when in doubt, included in cash from operating activities, the lease payments, variable lease payments, short-term lease payments, interest payments, okay? Variable and short-term lease payments. The only thing that changes a little bit is any money you spend preparing the asset for its intended use. So you've got to fix the machinery or something, that's, and you spend some cash on that, that is considered part of our cash flow from investing activities. And if it's a finance lease, the principal payments are going to be part of our I is investing, F here is financing. So if it's preparing asset for use, that's cash flow from investing. Principal payments are going to be financing. Okay. Okay, good. Lease disclosures. I'm not going to sit here and read disclosure requirements to you. I don't want you to go into a coma on me. But I do want you to make sure that you have flashcard either in your Becker cards or somewhere what the disclosure requirements would be. I've been saying that throughout our discussion now through our first 5+ chapters here. I want you to keep doing that. Look to see what the disclosure flashcards are and keep them close to you, because every now and then the exam will come up with what needs to be disclosed, and it's just a requirement that you have to have memorized. So make sure you've got some flashcards that help you memorize what needs to be disclosed for these different topics. And leases tends to be one that they like to ask about more. So make sure you've got all these things somewhere on a flashcard as to what the disclosure requirements are. Okay, good. Let's go ahead and let's take a look at a couple questions. Okay. And then share results, stop sharing results. Okay. And let's take a look at this first question, question number 1. Okay, guys, let's go ahead and do our best to wrap this one up. Okay. And okay, we did okay. 60% of us got it right. This is not the easiest question in the world. The answer, at this point, I think you'll find that these are easier by the time you get to the exam, but you're maybe not having as much practice with these right now. But let's just go ahead and let's just take a look at this question and see how we would have answered it. Okay. So they're telling me that they have this lease and they tell me that it's an operating lease. Okay. So once I see that, I know that, okay, it's an operating lease. This question wasn't testing the criteria. So I'm going to go ahead and I'm going to amortize the liability. And that amortization on the liability is also going to be the amortization on the right of use asset, right? That's how we treat an operating lease. So we come over and they tell me that the annual payments are what? $5,200. So I pick up that $5,200 and then they give me the present value factor. So they don't even make me look that up or anything. I just sit here and I take 3.5875. Okay. And when I do the math on that, I get what? I get 18,655, right? Okay.
Yes.
So that's the amount that we set up as the right of use asset. That's the amount we set up as the liability. So now I know I need to amortize that as though I'm just amortizing the liability, and that's also going to be amortization of the right of use asset. They're identical, right, as they go through. So I take that 18,655 and they gave me an interest rate of what? 4.5%. So I have to multiply that by what? 0.045, I guess. Okay. And when I do the math on that, I get $839.47. That becomes the interest part. Although I don't call it interest expense because I'm going to take the entire payment and call it lease expense, right? The entire $52 payment, $5,200 payment. So I won't call it out as interest expense, but I do take what? I do go ahead and take the difference between the payment of what? 5,200. I subtract what is equivalent to sort of that interest piece. And when I do, I get what? What do I get here? 4,360.52. 52 cents. I subtract that off of what I had set up as the debit to the right of use asset, credit to liability, and I amortize that amount off, and I end up with something like, sorry guys, my writing gets a little bad, as you well know. It's even bad on my notes here. 15,294. I don't know. Whatever that comes out to. What is it? 40 something. Can't read my writing. 18,655 minus the interest, what's left after the interest part of this, the principal part of this,
48.
48. Okay, thank you. 48. Thanks, guys. Okay, and so you get what? You get 14,295. Close enough. Okay. Okay, good. Let's look at the next one. Okay, let's go ahead and take a look at this one. And, we have a flashcard on this, and it looks like, most of you maybe look back at that table or remembered what I asked you to flashcard here. The answer here is B, but let's just take a look at how we would have approached this question. Let's say we couldn't remember the flashcard, okay? And so you take a look and they say at the beginning of the lease, sign a 5-year lease with a written purchase option. So we've got a finance lease, and with the lease is reasonably certain to exercise and preparing the annual cash flow statement. After year end, the lease's cash flows from operation. Well, look, if we're sitting here and we sign a 5-year lease and we're going to have to pay some amounts out, there's no way that we're going to have a positive impact on any part of the statement of cash flow. There's not going to be any cash coming in from this. So we have to assume, well, okay, I guess they're paying cash out. So there's going to be a negative. And then you start to look at B and C. And let's say you can't remember this sort of more esoteric part of this, the variable lease payments. You look at C, negative impact with a portion of lease payment as principal, and you say, no, wait a minute. The part that is going to be going to principal is going to be the financing part of the statement of cash flows. And so you could almost sort of back into B by eliminating the rest of these. So again, make that flashcard, but you can kind of see how you might be able to rule out some of the other ones. Okay. Okay, good. Now I'm supposed to go back and I want to see if we can quickly finish up the sale leaseback before we take a break so that we're done with leases and we can turn our direction to turn our attention to foreign currency here a little bit. Okay. So sales leaseback, I'm thinking is page 12 somewhere. Okay, right here. Okay, maybe page 12. Yeah. Sales leaseback. Okay, good. All right. So what happens? Well, now we're going to have a situation where I buy a piece of property from you, and then, or I sell you, because we're looking at it from the standpoint of the seller. I sell you a piece of property, okay? And then I turn around and I simultaneously lease it back from you, okay? How am I going to calculate any gains associated with that, et cetera, when I sell you a property and automatically lease it back from you? So sale leaseback occurs when one party, seller that has control of an asset, transfers it to another party, and then with a subsequent lease of the same asset where the seller becomes the lessee and the buyer becomes the lessor. So now I'm leasing back the property from you that I just sold to you, okay? Now, when you take a look, we need to look at what is the repurchase option, okay? So to meet the criteria to be both a sale, both of the following have to be met. The option exercise price already is or will be the same as the underlying asset's fair value at the time of exercise. Alternative assets that are substantially equivalent to the underlying asset are readily available in the market. If both of these criteria are not met, the existence of the repurchase option will result in a failed sale and will be treated as a financing transaction. Okay, so flashcard those criteria to see how we're going to go ahead and calculate that. And again, with residual value, a sale cannot take place if control of the asset is not transferred to the buyer. And they tell us it is a qualitative judgment, but the more significant the guarantee, the more likely that the control has been transferred. In other words, if I'm guaranteeing you that I'm going to be paying you the fair value, then they say, okay, that could be evidence that there has been a sale. Okay, so let's take a look. Sales leaseback, sales criteria is met. Okay, so we've met one of those two sales criteria. let's just go up and let's look at the example here. Okay. So we have this billing company held equipment on its books with the original price of 500,000. Remaining useful life is 10 years. Carrying amount is 450. Now that I'm 415. Now that's going to be an important number because I want to figure out if I have a gain or loss on this. So I'm going to, put aside that number. On January 1st, year 3, billing sold the equipment to Crane for 490. Okay, so I sold the equipment to Crane for 490. The equipment at the time of sale had a fair value of 470. Uh-oh, what's going on here? If I'm basically selling the equipment for 490 when the equipment has a fair value of what? 70,000, 470, they're in effect saying, well, what they're really doing is they're lending you some money on this thing. So that part is going to have to be set up as a financing piece. So Crane agreed to lease the equipment back for 112,000 beginning year 4, and assume the criteria to qualify as a sale are met. Prepare the journal entry when the transfer takes place. So notice we're going to get the 490 of cash, but because the equipment only had a fair value of what? 470, we're going to sit here and we're going to take this what? Take this 20,000 as a financing, because it's sort of like they're lending you money because they botched this thing from you for more than what it was worth. So they're in effect lending you 20,000. We set that up as financing. Now we sold the equipment for what? 407. The equipment had a book value, should say. We sold the equipment, yes, for 470, but it had a book value of what? 415. So 470 minus 415 means we've got a gain here of this 55,000. And then all this part of the journal entry is the taking the equipment off the books, crediting the equipment at its original cost. And they backed into what the accumulated depreciation must be. 500,000 minus the 415 is where they got the accumulated depreciation to be 85,000. Okay. Okay, good. Now you take a look and we say that upon the execution of the sale leaseback, 2 transactions have taken place. The sale, along with the recognition of the profit or loss, would be recorded. Note that in order to record a profit or loss, the leaseback will have to be an operating lease. If the lease had met the owns criteria, it would be treated as a financing lease and a failed sale. Okay, and that's the case, then we would treat it the way we've already talked about, of it being a financing lease and account for it appropriately, and we wouldn't call it a we would have they're calling it a failed sale, but then we would just go into the financing lease criteria. Okay, this process that we've already talked about. Sales leaseback, if the sale criteria are not met, if that's the case, it is what? It is a pure financing agreement. We're assuming that you're just borrowing that cash from them at that point because you haven't met the financing agreement. And then you'll go ahead and you will continue to depreciate the asset the way you would any asset, and you amortize that liability the way you would any liability. So you're just going to take whatever the carrying amount of that liability is times the interest of 4.75 they told us that problem. That's the the amortization on the liability. The depreciation expense is going to be straight line, 415,000, 10 years left, 41,500 per year. Okay. Okay, so I know that's a little bit out of order, but I thought that was better to deal with that when we already had the context of how to handle other leasing agreements on a sale leaseback situation. Okay, so let's try now this question too. We kind of skipped it before, and to see if we can figure out how to account for the sale leaseback. Okay, guys, let's go ahead and let's look at this one. And I gave you a little more time on this one just because I was seeing some funny answers coming in, but then it looked like finally most of us got with the right answer here. For a minute there, D was winning. Okay, but let's just go ahead and let's take a look at this particular question. And they tell us that Anton owns equipment originally purchased for 4 years for $325,000 on January 1st, year 5. Anton sells the equipment to Bridge for $208,000. Okay, so they're going to sell it for $208,000. Okay, the equipment has a remaining useful life of 6 years, carrying value of $195, and fair value of $202. Uh-oh, what's happening? They're selling it for what? For more. This is the cash, right? This is the fair value of the equipment. They're selling this for more than its fair value. Well, that difference we said is what? Is equal to a liability. And so we'd have to go ahead and credit that liability for $6,000. Okay. I'm not sure why D was coming in. Maybe you were calculating a gain or something. Okay. Question. Okay, let's go ahead and let's take a quick break, and we will come back after the break. I'm not going to go through the discussion of the derivatives, okay? The exam is de-emphasizing derivatives, and so I want to spend our time here talking about something that I know the examiners have asked, and something that I think could affect how you're supposed to handle a consolidation question that I know you're going to get. So with that as a tease, let's go ahead and let's take a quick break. Let's take about 10 minutes and we'll come back and pick up. Okay, I'm going to pause the recording. So somebody remind me to start it back when we get back. Okay, good. Thank you very much, because there's nothing worse than getting to the end of the class and you realize you didn't record. Okay, good. So let's go ahead and let's take a look. And we see that we could have foreign currency transactions. Now, what happens here? We have a foreign currency transaction. That means this is two unrelated companies. They're simply going to, have transactions with each other, and they're both using a different currency. And so we're going to see that on page 50. So I'm just going to put C page 50. You don't have to go there now. We'll look at that a little bit later. Okay. Where we're going to spend most of our time is on foreign currency translation / remeasurement. Okay. Now this is what happens. Okay. / remeasurement. I don't know why they didn't say remeasurement. Okay, now this is what happens when we are basically going to have to turn a company's financial statements from one currency over to another. We either call that translation or remeasurement. Okay, now one of the key things that we're going to have to think about here is exchange rate. Now, sometimes the way I look at this, students think that I'm telling you, you have to memorize the exchange rates between, pounds and dollars, RMB and dollars or something like that, rubles and dollars, and you have to have all the exchange rates. That's not what I mean. Okay, they would give you whatever they want the exchange rates to be, but in a question, they will give you several different exchange rates. And it's going to be your job to know which of the exchange rates that they're giving you here, current or historical, et cetera, as we're going to go through these, would you pick up for the problem depending on the fact pattern. Okay, so let's just understand what some of these are. Okay, current exchange rate is the rate at the current date for immediate delivery. It is sometimes called the spot rate. Why don't you flashcard that the current exchange rate is sometimes called the spot rate. Okay. Then we have what? Historical rate. Historical rate was the rate in effect at the time that you acquired an asset or at the time that you had an issuance of stock. Okay, that's the historical rate. Now, weighted average weight, okay, exchange rate. The weighted average exchange rate is often used for transactions that occur evenly throughout the year. Okay, so sales is a good example of that, but also could be used for cost of goods sold and inventory. Okay, by that, if the problem tells you that they acquired and sold inventory, and the key phrase is what? Evenly throughout the year, evenly throughout the period, then you would use the weighted average for your cost of goods sold and for your inventory. And they often do say that in questions. So make sure you're aware of that. Okay. Now, the reporting currency is always the US dollar on the CPA exam. USD is US dollar on CPA exam. Okay, always the US dollar on the CPA exam. Functional currency is basically where the primary economic environment is of the entity. and you can flashcard that. So if we say that an entity does most of its business in London, then the pound is the what? Is the functional currency. If we say the company does most of its business in the US, then what? Then the functional currency is the US dollar. And in that example, there'd be no difference between the functional and the reporting currency because the reporting currency is always the US dollar. Okay? On the CPA exam, anyway. Okay? Okay, good. Now you come over and we have foreign currency translation. We have foreign currency remeasurement. These are two methods that we will use, and we will use these depending on what the fact pattern is telling us about the question. Okay. Now, what exchange rates we use are going to depend on whether we're using translation or remeasurement, and it's going to depend whether we're talking about a monetary or non-monetary item on our financial statements. Okay. Now, when you look at the monetary and non-monetary items, really that's constituted on our balance sheet, we take a look and you can see that cash is considered monetary. Okay, you can see that accounts and notes receivable are considered monetary. So if you need to flashcard this table, do that. Okay, non-monetary classic example is what? Buildings, but notice what? Inventory is considered non-monetary. So what I like to use as an example, cash does not change as the price index changes. So what happens? If I'm sitting there and I fall asleep with $1 million in my pocket, my bag next to me, whatever, I wake up 10 years from now, I still have $1 million, don't I? Okay. Whereas what? With a house is what? A non-monetary asset, meaning that, hey, I might have bought my house 10 years ago for, $100,000, and now my house is worth $300,000. So the value of the house changes with the price index. Okay, so that's how you determine a monetary versus non-monetary. It's pretty straightforward, but if you have to flashcard this list, do so, because which exchange rates we're going to use are going to depend on whether it's a monetary or non-monetary asset. Okay. Okay, so we're going to come over and we're going to look now, you can go past this, at these three scenarios and see what we're supposed to do. Okay, but these scenarios are written very generically, and sometimes it's hard to really understand fully understand what's going on here when you sort of have this generically written discussion. So what I have here, where'd it go? I guess I didn't open those in yet, so I'm just going to open them here under Chapter 6. I have two foreign currency examples, and we're going to look at example 2 first. Okay, and if you don't have this in front of you at this point, don't worry. You can see it on the screen, and you can download it and take a look at it a little bit later. So I guess I want to save this, I guess, so it'll open up. Okay. Okay, it always fights me to open up in. Someday I'm going to take a class on how to make this thing work right. I mean, I'm downloading it. Any thoughts on how to make it open in PDF so we don't have to look at it in this silly window here?
Yes, if you go to the folder that you downloaded it, instead of opening it, like, yeah, and then look for it in the folder.
Right, but what folder did it go to? Download, I guess?
Yes, probably.
Okay, good. Maybe that's gonna work. I just don't understand why it doesn't open itself right there when I hit download and hit open, but okay.
You can set your default to have it open in the annotator.
Oh, really? Okay. Um, so let's see if I can look at this now. And I've got the wrong one open. I'm sorry, guys. Still not liking the way that's looking. Okay, hang on a second. I'll tell you what, I think we are better off just opening it like this, because that's a different one. And let's just see if we can work with it right here. Okay, I think we can. So I think you can pretty much see that, and I'm not going to write on it. Okay, so what I'm trying to do here, not very successfully, is give you an example on these two slides that I'm going to go through that are posted there under chapter 6. And I'm going to show you how you would apply a specific example to the scenarios that are back in the book. And then we're going to look at those scenarios. And I think they're a little easier to understand if you have a sort of a practical, specific example. Okay, so let's just look at this. So I have a US company, and the US company has an English subsidiary doing most of its business in the US. Now, if that's the case, what's happening? The US dollar is the functional currency, and the US dollar is always the reporting currency on the CPA exam. So when the reporting currency and the functional currency are the same, that means you use the remeasurement method. And so we're going to remeasure the English subs financial statements denominated in pounds, and then that is considered the local currency, to the functional slash what? Functional slash reporting currency, the US dollar. Okay, so let's go ahead and take a look. And what rate should we use? And this is why it becomes important that you know monetary versus non-monetary. If it is on the balance sheet, if it's a monetary asset, we use the year-end rate or that current rate. If it's non-monetary, then the rate we should use is the historical rate, unless we're talking about inventory, in which I told you that could be weighted average if the problem tells me that they acquired and sold inventory evenly throughout the year. When we get to the income statement, we use weighted average for things like revenue, payroll that occur evenly throughout the year. If it's a balance sheet related item on the income statement, for example, depreciation expense, then we are going to go ahead and use a historical rate. However, if it's cost of goods sold and the problem told us that the inventory was acquired and sold evenly throughout the year, you could use weighted average for that. Okay, so you really need to look to see if they say that about inventory, about cost of goods sold. If they don't, then use the historical. Okay, now we will go ahead and start by remeasuring the balance sheet, and we will go ahead and plug whatever we need to into retained earnings to make the balance sheet balance. Whatever it is that we plug into the balance sheet to make the balance sheet balance is then going to force what we're saying our net income is for the period. We will then take that net income to the income statement, plug in our net income on the income statement, and any difference between what our net income would have been had we not made that plug versus what it is after we make the plug will be the foreign currency remeasurement gain or loss, and it is part of our income from continuing operations. So we're not going to be dealing with the F in puffier at this point when we're using remeasurement. Now, If you're in a situation where you're dealing with a, say, US company with an English sub doing most of its business in England, well, now the local currency, the pound, is also the functional currency. And when the functional currency and the local currency are the same, we use the translation method. Okay, and we will translate now the pound, which is the what functional slash local currency, the functional currency, to the reporting currency, which is always the US dollar on the CPA exam. So when you see a fact pattern like that, that means you translate, okay? And when you translate, then you're going to use, for the balance sheet, you'll use year-end rates. For common stock and APIC, you'll use the historical rate. That will have then the balance sheet translated. You start with the balance sheet. That'll have the balance sheet translated. Then you go to the income statement. Actually, start with the income statement. And then you will go ahead and close the net income to retained earnings. Then you go ahead and translate the balance sheet, and you use these appropriate rates. So down here, I can't write on it the way they have it. I don't know if you can see my cursor down there right now. That's not where I'm putting my cursor, but it's saying I am, but I'm not. You're seeing it that way, but I'm putting my cursor right there. You start with the income statement, close net income to retained earnings, and then your plug is going to be on the balance sheet, and that plug on the balance sheet is part of my comprehensive income. Okay. All right. So that's just to give us a quick visual. But what I want to do is close this. Pain the butt thing here and go back to my textbook. Okay. And let's just go back here. I'll put it back to full screen. Okay. And let's just take a look here and notice, guys, they talk about remeasurement, translation. Okay. And so let's just look at the words in a more generic form as to how you might see them on the CPA exam. Okay. So what happens? We use the remeasurement method when the reporting currency is the functional currency. And that's basically what happened. US parent, English sub is doing most of its business in the US, right? That was our first scenario. Okay. Then the remeasurement method must be used. This is when the foreign subsidiary is highly integrated with the parent, serves primarily as a sales parent's outlet. Day-to-day operations of the subsidiary depend on the reporting currency. So since in our little example, English subsidiary, US parent, for that first scenario we looked at when we used remeasurement, the English sub was doing most of its business in the US, right? Okay. Now you look at this next example where we use our scenario, if you will, where we use the translation method. And now what? The foreign subsidiary is relatively self-contained. Remember, in our second scenario, English sub, US parent, English sub, the English sub is doing most of its business in England, right? Then what happens? It's relatively self-contained, operates primarily in local markets. Day-to-day operations do not depend on the reporting currency. They're a US subsidiary, but most of their business is going on in England, right? Now, I'm not going to show you the slide that I have for the 3-country example, our third scenario, but I think you can imagine here now what's going on without a specific example. So let's take a look. When the functional currency of both the subsidiary differs from both the subsidiary's local currency and the reporting currency, the subsidiary financial statements first need to be remeasured from local to functional, and then must be translated from the functional to the reporting currency, which is always the US dollar on the CPA exam. So what are you going to do? First, you remeasure, then you translate. So what if, the local currency was the pound, but they were doing most of their business, I don't know, in Italy or something. Well, now I guess maybe the lira would be what would be the functional currency. So you'd first have to remeasure from the pound to the lira, and then from the lira, you would translate to the dollar. Or I don't know, do they still use the euro? I don't know, whatever is going on with these currencies nowadays, who knows? But if you have three countries, you first remeasure from the local to the functional, where they do most of their business, and then from the functional you translate to the reporting. And again, the reporting of the parent company is always the US dollar on the CPA exam. Okay, all right, now you come over, and all they do on these next several pages is tell you what exchange rates to use if you're using remeasurement. And I've already given that to you. I'm not going to repeat that here. We saw that on that little flashcard that I was trying to open, that I didn't like the way I was opening it. We saw that already. So, and you probably have flashcards in your Becker flashcards that do that as well. So you could use the flashcard I gave you. You could get the Becker cards, but this is telling you, well, you could use your Becker cards, but this is telling you here what exchange rates to use for the different financial statement items on the under the remeasurement method. If the fact pattern indicates to you that you should use the translation method, then you will use the appropriate exchange rates that they're telling you here for the different financial statement items. Okay. Okay, now after all that, let's just go ahead and let's take a look. Let me kind of tell you again there, but I think you've got enough. You've got enough weapons now to help you remember what rates to use in different situations. Okay, but what I want to do is just kind of compare how we're going to do translation remeasurement. Remember, if there's a third country, first remeasure, then translate. So you kind of put the two things together. But let's just look at this example, which contemplates just two countries and how you would handle translation, how you would handle remeasurement, okay, depending on the fact pattern. All right. So they go ahead and they give us this information about the parent company, and they have this subsidiary, and they give me the different exchange rates, okay, for different periods. And then they go ahead and they give me the weighted average, okay? And they tell me that inventory is acquired and sold evenly throughout the year. So I know not only do I have to use weighted average for my revenues, for my expenses, but I also have to use weighted average for my inventory and my cost of goods sold. And they tell me that the fixed assets were acquired in December 31st, year one. And so now I'm just going to go ahead and I'm going to perform my remeasurement. I'm going to perform my translation. So they show them side by side. Now look, a company would use one or the other depending on whether the local currency was the functional currency, in which they'd want to sit there and translate, or what if the reporting currency was the functional currency, they would go ahead and remeasure, right? Okay, so let's just go ahead and let's look at remeasurement first. I'm gonna look at remeasurement first. And do you see those little, can you see those on your screen, those little watermarks, the 1 and the 2? Okay, all that's indicating to me here is that I have to, where I have to start, okay? So if I'm sitting here and I'm dealing with remeasurement, I'm going to start with the balance sheet. And I'm going to pick up the appropriate exchange rates. Now, I would have memorized this, that the exchange rate is 0.10. That's the current rate for a monetary asset like cash. And I would just go ahead and remeasure from whatever this, foreign currency is, right, to the dollar. Okay, I'm going from the functional currency to the reporting currency here, the US dollar is always the reporting currency. Notice I pick up that weighted average rate for the inventory. For my fixed assets, okay, I pick up the historical rates. Again, that was that initial set of information. And when I go ahead and I do all that, now I'm sitting there and I'm seeing that I have a total in US dollars of 63,653. So I was able to successfully remeasure my foreign financial statement into the reporting currency, the US dollar. Okay. Now, again, I do the same thing with the liability section. Okay. Now, if you were to sit here and total everything up, all these liabilities up right now, okay, you would come up with 52,600. Okay, I say liabilities. Your liabilities and your common stock. You come up with 52,600. Now, let me ask you, does the balance sheet balance right now? Not a trick question. Does the balance sheet balance right now?
No.
No, it's not balancing, right? So what do? I go ahead and I plug in this 11,053. And in this particular case, since this was the first year of operation, they're saying there was no dividends. They're essentially saying, okay, what you plugged in to make the balance sheet balance, you plug that into retained earnings. And since that was the beginning balance, the retained earnings was zero, you added the net income. There were no dividends. Ending balance of retained earnings to make this thing balance was 11,053. That means that what? That means that the net income must be what? Must be 11,053. So you go up to your income statement and you simply plug in 11,053 of net income. Okay. So again, we're talking about retained earnings here. Retained earnings was assumed to have a beginning balance of zero. The net income, we didn't know yet, presumably. The dividend was zero. So that means in the ending balance, we just plugged in there of 53,000. That means that the net income must be what? Must be not 53,000. Not, where am I getting 53,000? Sorry, guys. The ending balance in the retained earnings was what? Where's my retained?
52.6.
Where am I? No, I'm showing you the wrong number here. I'm tying it to the wrong number. Sorry. No, the retained earnings right here. Retained earnings. Retained earnings, we're saying, had a beginning balance of zero. Okay. I'm saying at this point, I don't know what the net income is. Dividends, there was nothing in this problem to indicate to me that they had dividends. So dividends were zero. So the ending balance in the retained earnings is 53,000. The ending balance in the retained earnings is what? 11,053, because I just plugged that number in there. So if that's the case, how do I go from a beginning balance of zero, no dividends, to an ending balance retained earnings of 11,053? That means the net income must be what? Must be 11,053. And I take that number and I plug it into my income statement, saying that the dividend, that the net income was 11,053, right? Hello?
Yes.
Okay.
Yes.
Okay, good. Now, just to play with it a little bit, okay, let's say they tell me that the beginning balance in the retained earnings was 56,000 or 56, and they paid a dividend of 3. Well, then when I do this analysis, beginning balance is 56. I got to figure out the net income. Dividend is what? Dividend is 3. And if I have to plug what? If I have to plug 11,000, God damn, it's going to be right on the line here. If I have to plug 11,000, if 11,053 has to be the ending balance in the retained earnings, that means that what? That means that my net income must be 11,000, right? And so my plug wouldn't be 11,053. My plug would be what? Would be 11,000, because I would already had a beginning balance in the retained earnings, and there would have been some dividends. Okay. Question? Okay, so you might have to work a little bit more than just that number being the net income. My point is, whatever the net income is that has to get, that's necessary to get the ending balance and the retained earnings to be whatever it is you need to make the balance sheet balance, that's the number that becomes your net income that you then just go ahead and bring up to your income statement. Okay, so now I've got my income already, but now I go ahead and I start to remeasure my my income statement. That's why there's a 2 there, right? I do that next. So I go ahead and I start doing all of these different things, and I use these different rates. I use the average rate for my sales, weighted average rate. I use the weighted average rate for my cost of goods sold. For my historical income statement items, for my balance sheet related income statement items, I use the historical rate, my depreciation, so on. I get what? I get 66,938 for revenue, 62,739 for expenses. And when I subtract 62,739 from 66,938, where I come from, I get 4,199. Is that the number that you get? 66,938 minus 62 is 4,199, right? That should be my net income, but I already plugged in a number for my net income, didn't I? So what I do is I have what they're calling the second plug here. I just plug in a number into the income statement to make it what? Balanced to what I've already stuck myself with as the net income. And that number is called what? The current foreign currency exchange. In this case, it's a gain because my net income is going to be larger than would have been without that plug. So that's a gain. And that is part of my what? My income from continuing operations. It's on the income statement. You can put IS. I'm just going to report it right there on the income statement. Question? Okay, good. Then I go ahead and I look at translation. Now, again, you can see those watermarks. So I'm going to start with the income statement, and then I'm going to work my way down to the balance sheet. Okay, so again, I go ahead and I use the appropriate rates now for translation. And I think that for my income statement items, they told me to use the weighted average of everything. So I go ahead and I do that just like any income statement. I go ahead and I calculate my net income. My net income here now in US dollars is 5,354. I go ahead and I come down and I just stick that into, and again, this is a little bit funky because when I stick it in there, my 5,354 becomes the balance in my, again, in my retained earnings. It becomes the balance because they're assuming retained earnings had a beginning balance of 0 and there were no dividends. Okay, But whatever you do, you stick into retained earnings. If there was already a balance in retained earnings and I stuck my net income in there, it would go up to whatever the new balance was in retained earnings. Okay. But now I'm sitting there and I have a number plugged in there for my retained earnings, and it so happened to become exactly my net income because they're saying the balance of retained earnings was 0. And then I go ahead and I start to do what? I start to translate using the appropriate rates based on the fact that I'm using the translation method. That's why it's important. You have to know what rates to use depending on what method you're in. I go ahead and I do all that work. I now go ahead and translate the assets. I translate the liabilities. I translate the common stock, the retained earnings. Well, I didn't have to translate that because I just plugged it down in US dollars. But when I add all those numbers up, 34, 13, 2, 36, 5, 3, 5, 4, whatever, when I add all that up, I get, again, my writing is the worst ever. I get 57,000, is it 954? Anybody add those numbers up? It's okay, I'm gonna go ahead and do it because at this point we're over the rainbow in terms of time. 3,400 plus what? 13,200 plus 36,000. Is that what you get?
57954.
Thank you. 57954. Okay, good. So I get that number. Thank you. And does my balance sheet balance? It does not. I'm showing assets of 40,800. Meanwhile, I'm showing liabilities and stockholders' equity of 57,954. The balance sheet doesn't balance. Does the balance sheet have to balance? Yes, it does. So I just go ahead and I plug this number in. And when I do, I'm reporting that as part of my accumulated other comprehensive income. And when I do, what? Now I get the balance sheet to balance. That plug is part of my OCI, right? Okay. Question? No? Okay, good. Okay, so that's the way that all works. Now, if you have individual foreign currency transactions, okay, what happens here? Well, now we're going to basically have to take as gain or loss each period it changes in the exchange rates. Okay, so let's just take a look at the example, and I think it'd be pretty straightforward what we do here. And this is much easier than the translation or the remeasurement. Okay, so we have these situation where they purchase goods on credit for 100,000, and they're going to pay for these finally in year 2. Okay, so at the time that we do the transaction on December 1st here, we just go ahead and we, use the exchange rate to turn the pesos into dollars. So we debit purchases, we credit the accounts payable, we turn into dollars. Now you notice here that what? By the end of the year, the exchange rates have moved in our favor. Instead of having to give up 10 cents for every peso, I only have to give up what? I have to give up 8 cents for every peso. So now we're going to look at what? The 10 minus the 8. Things have moved 2 cents in our favor times 100,000 pesos. So we don't owe them as much in US dollars anymore by the end of the year. We're not going to pay them until year 2 in February. And we have what? A transaction gain. That, of course, is reported on the income statement, right? Okay. And then when we finally go to pay in February, now the exchange rate, let's go back up, look at the exchange rate, has moved what? Against us by a penny, right? So by the end of the year, we were like 2 cents ahead. Now we're only 1 cent ahead. We've lost a cent per peso. So what happens? Well, we're going to go ahead and just debit the accounts payable because we're liquidating it. We're going to calculate the foreign transaction loss because we lost a penny. That's going to get debited 1,000. That's reported on the income statement. And then, of course, we go ahead and credit the cash for the 100,000 pesos times the 9 cents per peso. Okay. All right. Let's look at these questions here. We'll start with, obviously, with number 1. Okay, guys, let's go ahead and let's take a look at this one. Can take you, sorry, I think I need to pull on you before you had a chance, but let's just go ahead and take a look. And most of us got this right. And this problem gets a little bit annoying because they give you all of this information. And then at the end of the day, they're simply sitting here asking us, well, where should you report a remeasurement gain or loss? Where should you report a translation gain or loss? So we look and they tell us that they maintain their accounting records, and Switzerland is the functional currency, and that's the Swiss franc. And we want to remeasure Schnell's for year 4 financial statements, result in the 7,600 gain, and translation. So remeasurement resulted in what? Resulted in the gain. And then we have what? Translation resulted in $8,100 gain. And they ask us what should go to the income statement. Well, on the income statement, that was where we reported what? Remeasurement went to the income statement. The what? Translation gain or loss is part of comprehensive income, right? Okay. So that was really just seeing if you knew where to report remeasurement, where to report translation. And that is on that flashcard. Translation goes to other comprehensive income. Remeasurement goes to the income statement. You saw the little watermark example we had. Okay, good. Let's try another one. Okay, go ahead and try to wrap this one up. Okay. I'm gonna end the poll. And yeah, most of us got this right. Okay, I would have thought this one would have been a little easier, but let's just go ahead and let's take a look at it. But the right answer is D. So we're sitting here and we have what? We have September 22nd, year 4, Yumi Corp purchased merchandise for an unaffiliated foreign company of 10,000 units of the foreign company's local currency. Now I'm going to pick up that 10,000 units because I know that I'm going to have to multiply something by that 10,000 units, right? On that date, because I have answers here in dollars, okay? Now we sit here and we say on that date, the spot rate was 55 cents. Okay, so when they recorded the transaction, the rate was 55 cents. Yumi paid the bill in full March 20th, year 5, when the spot rate was 65. Okay, well, let's see when they want me to calculate this, because they tell me they paid it in year 5, but the spot rate was 70 on December 31st, year 4. What amount Yumi report as foreign currency transaction loss in its income statement for the year ended? Oh, well, if it's year 4, then I'm going to ignore this nonsense about year 5. I don't even know what it was in the end of year 4 for year 5, because year 5 hasn't come yet, right? So I'm going to sit there and I'm going to say, well, look, exchange rates moved what? Moved 15 cents against us, times the what? 10,000 units means that I have a $1,500 loss. Okay. Okay, guys. Chapter, any question on that? Okay, chapter 6 is a hard chapter. It's unrealistic to think that we would get all the way through it in 3 hours. And I am not inclined to start a module and not be able to finish it. I cannot get through module 5, module 6 in any kind of reasonable time frame for you now. So we will pick up module 5 on Tuesday. So this is giving you an opportunity now to catch up with any undone homeworks from chapter 5 and get through module 4. I've given you that little extra assignment of having to look at on your own. We will pick up module 5 for chapter 6 on Tuesday, and we're going to go ahead and put this one in our back pocket and get out a little earlier, because I can't finish module 5 or module 6 in the time that's left, and I don't want to rush it. Okay. Okay, guys, I will take that silence as that there's no questions, and we're going to get out early, and we'll pick up module 5 on Tuesday. All right.
Thank you.
Thank you.
Thank you.
Have a good night.
Good night.